was Keeneland, and these people here love it. So, all right, so let's go back to layers so it's a little easier to see. So Lexington, anyway, so we love Lexington. It's got this urban growth boundary. You can't build outside of it unless you got 40 acres, and you can't build like an apartment building or anything like that. You can put a single family home on. They want to keep it. They want to keep the horse kind of feel going on. They want to keep it. That's a big industry driver in this area, and so they want to keep it like that. So you get some suburbs. This Lawrenceburg, actually, there's a big manufacturing plant coming in with a lot of jobs. Nicholasville is a nice submarket. So you can see these are like suburbs, but you can see there's farmland in between the suburbs. Georgetown's got the Toyota plant, but again, from going to Georgetown to Lexington, you have to drive through a field. Then there's horse farms in between all these little submarkets. So, and if you just jumped on, like I said earlier, Lexington, you can basically cut it right in half, okay, east and west. And the south part of Lexington is the more desirable area. The north part is the less desirable. Again, there's pockets, as we go in, but for the most part, that's kind of how it is. When we go to the east side of Lexington, the southeast side, this is the best area, this Hamburg area. And so this is kind of the better area, or one of the best areas in that kind of Lexington, the Lexington market. So as you can see, our property is in this location. It's certainly not our property is not A plus location, but it's definitely A minus or very high B plus, a very desirable location to be in, but a little bit of older stock. But there's a lot of new development kind of coming in, or has been happening for many years. All right, so I'm going to go back to, actually, it's right here. Sorry, it's a little hard because I got so many things going on here. Can you guys see the presentation right now?
No.
Oh,
yes.
It's just minimized, right? Can you see it?
Correct.
Perfect. I'm going to get it to present mode right now. Come on. There we go. All right. Well, we're on slide 15. That's not convenient. All right. Let's get back to the start. All right. So anyways, thanks to everybody for joining us. I'm going to start with just a couple little things here. This opportunity is a 506C. What that means is that this is for accredited investors. If you're not accredited, we still are happy you're here. However, unfortunately, because of the SEC rules, we can't have you invest in this property. We'd love to talk to you about future investments, but on this one, if you are not accredited, unfortunately, we can't have you invest. Just the rules. We don't make them. We just follow them. So this property, like I've been talking about, is in Lexington, Kentucky. We really love the Lexington market. If you were on when I was first talking, we love the fact that it's got this urban growth boundary, which really limits the new construction. It really helps eliminate a lot of that urban sprawl that sometimes, or suburban sprawl and flight that you sometimes see in cities. And it keeps things more located. It also keeps the industry, which is the horse farms, intact. And that draws a ton of business, an amazing amount of business and money comes into Lexington and Louisville because of the horse industry. So we really love that fact. And I love this market. It's just a great place to be. Invested here back in 2017, held properties until 2021, sold some properties, which will show you in just a little bit. And super excited to be back into this market, especially on the pops, which we'll go through the details of why we're really excited about the pops. We'll just be going through really the property, the trade area, what's happening, and why we really like this deal. Most of you know who we are, but just in case you don't, we want to give you a little quick background. Endurus Capital exists to identify and operate large multifamily assets in growing markets for the benefit, and that's the key word, for the benefit of our investors, residents, and surrounding communities. At Endurus, we really believe that first and foremost, our job is to take care of our residents and to take care of our surrounding communities. And we feel like if we really focus on the residents first, that that's going to ultimately benefit everybody. Not only are financially we going to benefit, but obviously we want to benefit by knowing we're doing something good in the community. And we want to make sure we're taking care of the residents. We don't focus just on investor profit only. If we do, maybe we all profit, maybe we all do really good. But did we actually treat the people that are in our buildings, that are really paying us, that are taking care of us? Did we treat them with respect and dignity? And so that's what we at Endurus really want to focus on. First and foremost is our residents and the culture that we're creating within those properties. In our experience, we have about 4,000 units collectively, and I believe it's about 400 million in multifamily commercial real estate. The three of us make up Endurus: Drew Whitson, Matt Bronner, and myself. And Drew is kind of handles more of that financial side, putting that aspect of the deal together. Matt handles a lot of finding the deal, underwriting the deal, communicating with the brokers, and I handle a lot of the asset management, construction management, and investor relations. So we all kind of cross pollinate a little bit, but those are our main focuses. And we feel together, the three of us really create an excellent team to be able, we've all done this individually, but together we've created a much stronger partnership and a much stronger, and I think more stable company. And so our properties are going to be better, right? The opportunity is going to be better for us. All right. I hired Denton Floyd in 2020, and they took two of the properties that I had and really did an amazing job. Big thing we really like about Denton Floyd is we love how they have the same kind of philosophy mindset. They really value the same things. When I'm talking about treating our residents with respect and dignity, Denton Floyd does just that. And so that's what we really like about Denton Floyd. They have a strong presence in Louisville. They have a strong presence in Lexington, but they're a really good firm as far as how they treat the residents. And then the other thing we really like is how they treat their employees. They do a lot of training, something every property management company doesn't do. And they really incentivize their employees that are going to be on site. They incentivize them financially, and they incentivize them to do a much better job. So we really like Denton Floyd as a partner, as a manager, and what they bring to the table. And then we have strong contractors as well that we like working with. All right. So about the property. This property is a 96 unit garden style apartment. And I already mentioned about the neighborhood. It's a great neighborhood. It's got a high average household income. It's right near shopping, restaurants, major roads, all the stuff that anybody's going to need. A huge positive with this property is it'll be cash flowing day one. The property has been, interior wise, has been completely renovated. Exterior wise, we need to replace the roofs. We need to do some landscaping, some siding, some HVAC interior. But interior wise, they've done LVP flooring, all new paint, cabinets, granite countertops, tile backsplashes, the whole works. And what this opportunity is, then you might go, well, what's the catch then? Why are we buying it? We're probably buying it for a super high price. Well, the opportunity is that the management hasn't kept up with the market. And so they kind of drop the ball on the management. They drop the ball on keeping up with the market, and their rents are quite a bit below. They're actually catching up, and we'll dig into that quite a bit later, but they're actually catching up right now. And even a cooler thing about it, and we'll probably talk more about this too, but a cooler thing about it is that Denton Floyd, our property management company, has taken over management on this property in the middle of March. And that's amazing because it just doesn't happen. They took over management. They've really started to collect on the rents where we would like to see the rents. They're getting closer to that. And they're also collecting a lot of the bad debt. And that was a big part of the opportunity too, is this previous owner just wasn't collecting rent from the residents. And so they were leaving a lot of income, a lot of net operating income, which is what the property is valued off of. They're leaving that all on the table for us. And so Denton Floyd has really just taken what our business plan is and the timeline and helped push that forward quite a bit by being able to get on site. So that couldn't ask for a better starting situation than that. Usually when a property management company takes over, when we buy a property, we see this kind of lag for a while. Well, that's already been taken out of the equation. And so now as we take over, we should just continue to see this upward trend.
We spoke so highly of Denton Floyd when we were being interviewed by the seller. It's actually why the seller hired them, because the seller was self-managing. And so they said, gosh, you guys really seem to know what you're doing. We looked into Denton Floyd. And so that's what made it so fortuitous that Denton Floyd was able to get this early ramp.
Yeah. I mean, no better opportunity than for the seller to, like Matt said, they're self-managing, they're trying to do it themselves, they're dropping the ball, they didn't have the right people in place. I believe they had a bookkeeper that was like their leasing agent, and it just didn't have the right people in place to be able to perform at a high level.
Right.
And of course they wanted to continue to perform. They wanted to be able to perform at a high level because this is under contract. They want to sell. Their plan is to exit. It's a bigger institutional player that needs to follow their business plan and needs to exit at the right time. And that really drives their investors' returns. So they're very motivated. And so hiring on Denton Floyd was critical for them to make sure this property actually executes the right way. And if it doesn't, by the way, which it will, but if it didn't, they wanted to have the right management in place.
Yeah. I think one of the other neat things to talk about as we relay sort of the message of this property is how much confidence we have in the professionalism and the ability for our property manager to execute. Those are the boots on the ground for us to see this property perform. And Denton Floyd will not take properties under 150 units. They are 150 units and above operator. They're willing to make this exception, I think, for two reasons. One is that we have a good relationship with them and we've done business in the past and have done more deals recently with them. And two is they want their name in front of that property, given its really strong location. Right. So to them, it's incredibly valuable. They're willing to come down to manage a smaller asset because they want their name on that location. They want properties in that area to see that they're managing that. So I think there's just a lot of momentum as it relates to that partnership and getting this property in the right direction.
Yeah, absolutely. Thanks, Drew. So just a few pictures of the renovations. You can kind of see what's happening with the units, and a couple of exterior pictures. Unfortunately, when we're looking at it, the exterior pictures, it was still kind of winterish. All right, I gotta pause this so you can see the interior of the units a little bit. I'll let this play for just a little bit on interior wise. This is an upper level which has carpet in the living rooms. The main levels, the lower levels all have LVP throughout. So just a little bit difference there.
And what made this seller unique is that they were out of touch with the market because they're based in Salt Lake City, Utah, and real estate is hyper local. But the seller was very professional in that all the units were standardized in terms of their renovations. So it makes them very efficient to market and gives us greater confidence in the rents that we can hit, because the property that you're seeing here, the unit that you're seeing here, is identical in all the finishes that you'll see throughout.
Yeah. And again, they're very professional. So the maintenance is, they're making sure they maintain a strong property. And so the renovations were done. It's a strong community. Just lacking in some of just staying with the market, really. So, and there's bathrooms being built right here for the exterior pool area. All right. And you can see the pool, which, again, siding, roofs is what we're doing. Some landscaping, just some cleanup around everywhere. All right. And then just real quick, property floor plans. Of course, you can look at this on your own time, but you can see kind of what it looks like. And then just an overhead view of the property. There's a nice pond on it. Just a very well located property. You can see some of the businesses around, some of the other communities that are nearby. So, and then lastly, and Matt will dive in more into the market, but you can see some of the shopping and restaurants that are around there. There's some really high-end restaurants as well around, some really nice shopping around that's not even on this map, but you can see there's a lot going on in this general area of the market, and which is, again, why we really like it. One of the things we're really focused on right now at Endurus is very well located properties. And of course, we think that multifamily is going to be strong for many years. But as we continue down this economic cycle, we like well-located properties. We really like strong areas that are going to continue to grow, that have good, strong jobs, that have population growth. And that's what this submarket, and that's what this market in general has, which is why we love Lexington, which is why we love this submarket, because we know this is a market that, as the economy changes, if we still own this property and the economy goes through a cycle, we know that this property, this location, will be the last to go down and the first to go up. We know that likely, as far as history, if history kind of shows itself the same way, good, strong A-class locations go down, as far as the percentage wise, go down the least and go up the quickest. So that's kind of our main focus right now as we're in this economic cycle. All right. So Matt, I'll let you get going on the trade area and move on.
Awesome. Thanks, Todd. We talk a lot about the location because that's the one thing that we can't change with money. And so we get hyper focused first on kind of the micro location here. And as I've spoken about this before, I always like to say that multifamily real estate is pretty basic. We need residents paying rent. So let's first look at residents. We want to be in areas that are growing. We're really excited about the micro location here on Man of War Boulevard, as Todd mentioned earlier. It's one of the most high traffic, affluent areas of Lexington. And then as you zoom out a little bit more and look at the city of Lexington, and then look at Kentucky and the Midwest in general, you can see we've really built our portfolio here. For those of you that have invested with us, we have several repeat investors on the call, have gone up through Tennessee into Kentucky and Ohio. We like this area because we see good, steady, predictable growth. We don't get the boom and bust necessarily of some of the more coastal markets, and we're more buffeted from some of the extreme weather events and cost swings that you will see. And then as we look specifically at Lexington, a lot of this comes from the fact that you have a large Central State University there, but we see a young, growing population. And as we'll talk more about that urban growth boundary, we are seeing demand increase, and then you're in an area of the country where supply is restricted. So let's go on to the next slide here. So we said multifamily, we need residents paying rent. So the next thing is we look at residents with jobs. And what you see in Lexington is something that gets us excited, which is growth balanced with diversity. So Todd mentioned earlier, up in Georgetown, you actually have the largest Toyota plant in the whole country. And yet no sector of Lexington, of the whole employment sector, makes up more than 16% of the economy. And on the whole, you still have an incredibly strong workforce, where one of the lowest unemployment rates in the nation at 2.6%. And so let's dig a little bit more into Fayette County, which we've got on the next slide here. So we look at all of these statistics here, and we'll come back to this urban growth boundary, but we get excited about a low cost of living because, yes, we want to bring rents up to market, but we have to ensure that the rents that we're forecasting are rents that our residents can afford. And so we've got a low cost of living, and we are well within the range of our comps, coming in below our comps in the immediate area. For those of you that know this area of Lexington, our year-over-year growth is under what this portion of the market has done over the last decade. And then as you look at that population growth, we are really accelerating now when you just look at what it's done over the last 5 years. And then for those of you that know and love this area, these horse farms are absolutely beautiful, and it's really important to the city and the local municipality that they preserve that. And so when you restrict supply, and yet this area continues to grow, and in our specific, one things you watch when you're in really well located properties is, okay, who else is building here? Because those are folks that can steal your residents, and you want to make sure then that you don't get over inundated with supply. We don't have any new units under construction. And so it just makes the housing stock that we have available here, specifically at the Pops and in this area of the city, all the more valuable. So I want to talk about kind of the greatest thing we like about Lexington, and that's really that we have history here. And so I think on the next slide, we can go into some of our previous purchases. Now, again, those of you that have known us and have worked with us have seen us grow throughout the Midwest, obviously being based here in the Twin Cities. We have a strong portfolio, and then have pushed into the Southeast and then up through Kentucky and Cincinnati. This is a much lighter value add than many of our previous investment opportunities. And you'll really see that supported by the financing strategy that we have in place here. We're excited that we've got some really good low fixed rate debt on this property that is financed by Fannie Mae. And that's enabling us to drive cash flow right out of the gate. And we're catching the property on a crescendo that Drew will dive into more as we look at the pro forma. I want to go actually to the next slide because we can talk about specific history in this market. We're excited because we have a history with Denton Floyd, and then we have a history here. So you have two properties in in Ashland Apartments and Cambridge Apartments that recently went full cycle. And as Todd said, there was a change made in 2020. So this was during COVID when Denton Floyd came on board, and these properties really tell the story of Denton Floyd. They were able to complete renovations. They were able to bring renovated units to market, restaff the properties, and place those properties over just a 9-month period of time into a position where they can achieve the returns that you're seeing here. So when you think about the fundamentals of real estate, we've got well-located property in a submarket that we know really well, a submarket that we have experience in, and a submarket, more importantly, that our property manager has experience in, still owns and operates properties here today. So I'll let Drew talk through how this all applies to our pro forma.
Yeah. Okay. Thanks, guys. I'm finally on. I love it. All right. So we'll talk about, here's our investment summary. So we're purchasing this property for $10.3 million. I think one of the things we didn't articulate in this story is that we had originally chased this property last fall, and it was originally awarded to us. They said, you got the deal if you're willing to come up on price. And we said, no, we know what this property is worth. We know that we can close. So they went to the next buyer in line, and no surprise, that buyer fell out of contract. They came back to us hat in hand and said, is your price still good? And we said, yes, let's get the deal done. So we stuck to our guns. We know that we chase a lot of deals. And so the fact that we landed this one at the price we needed, I think speaks tremendous value to the work that Matt and his team does on chasing these kinds of assets. So we're at this property at $10.3 million. Our renovation budget is pretty minimal. It's only $700,000. And this includes some of the exterior work, all things that we can do basically immediately after purchase. So for those of you who have invested with us before, often our renovation budget looks like 10, 15, 20, 30% of the purchase price. This renovation budget is like 6 or 7%, and it's all exterior, right? So it's really easy to execute. Because this property is in great condition, because it is in a really low crime score area, it makes our insurance cheap. We were able to we actually chose to go with a lower leverage financing product. So I think we're just doing, Matt, 70%? 70% loan to value.
Correct.
Yep. So 70% loan to value. And we're getting a fixed rate debt at 4.55%. This is fixed for 10 years. So no matter what happens to interest rates, we are at 4.55%. And actually the first 5 years of this loan, we're only paying interest. You know, it was, you can get these kinds of financing terms with fixed rate and interest only terms if the property is well located, if you use low leverage. And so we were in a position to really make this asset from the financing side, very incredibly conservative. We still have about $260,000 of operating reserves above and beyond our renovation budget. So our total raise right now is based on $4.8 million. As of this afternoon, we have maybe about a third of that already committed from existing investors. And so we are raising about 2/3 of that. The minimum investment is $50,000. Again, you have to be accredited. I know I'm personally putting in $100,000 into this deal, and Matt and Todd, as operators and managers, are going to also be putting in a similar amount. So we are personally financially committed to this deal along with our investors. We don't have any multiple share classes. It's a very straightforward deal. 75-25 split. We have a 7% preferred return to our limited partners, and we're targeting a 15 to 18% IRR. Because I'm a finance professor, I have to deviate for a little finance lesson here real quick. And I was talking with these guys beforehand. This asset, if you were to take and do an unlevered IRR, right? An unlevered IRR means if I was to purchase this property with all cash, our IRR on an all cash basis is close to 10%, which is really high in this business. Most of our deals, most of operators' deals tend to operate in the 7 to 8% range. Being in a double-digit unlevered analysis means that this property can achieve some of these returns with less risk. And I think that's really the story of this property, is we have a property that is fully renovated. It is owned and operated by an experienced property manager. We have a conservative financing structure, and we have a very straightforward investor-friendly split on this transaction. Also, by the way, feel free to put questions into the chat. I'm happy to discuss. We're happy to answer questions at the end, but as they come up, drop them in there and we can answer the questions. We are going to be doing a cost segregation analysis, which will help accelerate some of the depreciation. So for those of you who are looking for passive losses, we're going to push as much into our negative numbers into that K1 as possible. But this is truly a 5-year hold, by the way. We have some of the other deals that use bridge financing that are more value add turns. We have exit options along the way. We can exit at year 2, exit at year 3, or do refinancing. Because of the structure of this deal, because we think this is a simple, great cash flowing asset, we don't think there's any scenario that we'd exit this asset before 5 years, right? So this is truly a 5-year hold. It's going to be cash flowing. Here's some of our rents, 96 units. The current rents are $840 and $940. What we have seen since our property manager has taken over is that they've been able to actually already achieve really close to these market rents. I think our 2 bedrooms are at $1,100 and the 1 bedrooms are at $900. So we already are continuing to keep the property full. It's 97% occupied as of today. It is continue as they turn over these units or increasing the rents and getting these back up to market, and they're not having any trouble doing that. So it gives us a lot of confidence that our rent targets are right in line with what we need. Yeah, go to the next slide. A couple rent comps, right? When we talk with our investors about putting these deals together, we talk about 2 things. There's rent comps, like rent per square foot, and unit transactions. And on the rent comps, we have a huge amount of well-located properties near this, near the pops that provide really good comps. You can see a lot of commas in these prices, right? Our 1 bedrooms and 2 bedrooms, $1,100, 1,000, and they're generally going to be even sometimes a little bit smaller. So in terms of our rent per square foot comp, we are right in line with the market. And because we have an operator like Denton Floyd, we've got a great sense of where the market has been trending and where they anticipate we can continue to push rents as we finish out the exterior of the property to make sure it looks consistent with what the interior of it also looks like. Here's our portfolio projections. Based upon a $4.8 million investment, we're at about a 16% return. I do have to tell you right away, though, when we built this year 1 through year 5 forecast, what we do is we account for a certain amount of vacancy and loss to lease, meaning a certain amount of rent that needs to be collected or that's not going to be there. Right now, our forecast, I think for year 1 is like 15 or 16%. I think it's going to be dramatically lower than that. I think right out of the gate, because of having our property manager on site and seeing those kind of rents, we're getting the collections we want, we're getting the rents we want. And so I think this actually ends up being, I think there's a lot of potential upside to this kind of a forecast. And as we get into the first year or 2 of ownership, I think we're going to sort of see that. So I think if we had to update this today, it would probably go up. But I think as a starting point for our investors, we are clearly on the right track. You can sort of see what we're doing with our spend. Here's what our distribution looks like. Cash flow distribution, you can see what the ROI starts to climb. This cash flow forecast. So if you invested $100,000 as of when we put this projection together, it's supposed to be close to 5%. I think we'll be closer to 6 or 7%. I think we'll actually hit that year 1, that pref in year 1, or get really, really close. And so we're deeply optimistic. Our goal for our investors is always to provide you the best return with the least amount of risk. Our target is to double your money in 5 years. $100,000 comes in. Our expectation is that over a 5-year period, we're going to be able to double that for you, and $200,000 is going to come out. Average annual return close to 20%. Internal rate of return, again, that 16.3, that IRR percent. The unlevered is closer to 10.
Just to hit on one point there that Drew mentioned in terms of the ground shifting positively under our feet. We work with Denton Floyd on other properties that we have in the area, and we obviously keep close tabs on the pops. And just last week, they shared that they had updated their market rents to be exactly at our pro forma rents, because occupancy has shifted up from 97. They're now 100% occupied. And those of you who have experience in this business know that we typically look to see about 95% tells you your sweet spot. So if you're at 100%, your rents are too low. So we're just really encouraged at the positive momentum that we're seeing and the line of sight we get to it from having Denton Floyd on site right now.
Yep.
And
So here's what our time
raised that quicker, but they had to get permission from the current owners. They couldn't just get permission from us.
Yeah.
As much as we'd like.
Yeah. Right.
I think we did walk through and say, hey, could you fix that before we buy it and fix that? So I think we gave them a little to-do list. So I think we got some things taken care of. Here's our timeline. Obviously, today is May 4th. We're accepting commitments onto our portal, and you'll get a link to that after this call. And if those of you invested with us before, please just go onto our site, go to the pops and put your commitment in. This is an accredited only investor. And so there's a couple ways that you can prove that you are an accredited investor. There is a verification service that you need to submit some documents to. And within, I think, a matter of an hour, less than a day, they will get back to you with a letter that says, yes, we verify that you are an accredited investor, meeting the standards of requirement, either through net worth, income, or investor sophistication. If you didn't want to go through that process, all we need is a letter from your CPA or some legal representative that proves this, right? That we can put in our files that says, in case the SEC comes back and says, prove to us that you followed the law, we have a document that we can prove to them that we are in compliance with SEC laws. So that's today works. Yep.
As you go through the portal as well, it'll take you through the beginning process. You'll have to log in there, but it'll take you through that beginning process. And actually there's a letter template that you could just send to your CPA. That's the easiest way to do it. If your CPA is looking at your financials and knows you're accredited, that's a quick, easy, just have them fill that out. It takes 2 minutes, and then they can sign it, and boom, you put it in. And within a few hours, you get approved.
Yep. So May 4th, that's today. We're starting to accept our commitments. By May 12th, we want the subscription agreements signed and provide that accreditation reference. We'd also like the funding by the 12th. Our plan is to close on the 23rd. That is when our extended our contract ends. So we have to purchase that property. And so that's on May 23rd. So things are going to happen here pretty quick, and we're very confident that we're going to get there. But this is the timeline. We want to make sure people stay on this timeline. If you have any trouble, please reach out to us. But we want to keep this project, get this capital in so we can get this property closed. Couple general questions. Will the partners be investing? Yes, all of us will be investing, at or more than 6 figures. You have to be accredited. Minimum is 50,000. We will accept retirement funds, qualified funds, solo 401ks, IRAs, but you have to be able to send funds in and receive distributions via ACH. Right? If we're going to do distributions, we can't be mailing checks. So please make sure that your custodian can accept distributions through an ACH model. We went through a little bit of the timeline. We have a 75-25 split starting in year 1. I think one of the neat things about this deal is that we've got our permanent financing right out of the gate. And we anticipate that we're going to be doing distributions after our first quarter of ownership. So we do anticipate that capital will be flowing out of this asset positively right away. Tax benefits, absolutely. You can get your share of all the depreciation and the long-term capital gains. We will do the case study. And I think actually jumping right into our first question here, do you have an estimate of how much tax losses per $50,000 might be available to be shown in the first year? I can't tell you on this deal. Every deal is structured differently. Our cost segregations are sort of can be very different based upon the composition of that asset.
Drew, our cost segregation company that we use gave us an estimate. I actually went through it the other day with us. So there's certainly, this is just a very preliminary, but anywhere between about 50 and up to about 70% will be a cost segregation in the first year. So,
Yep. So if you invested $100,000, the passive loss due to depreciation would be -$50,000 to -$70,000.
Yep.
It could be more depending on how the property operates and other things that we get to complete between purchase and the end of the year. So that could go up or down as well.
But if you use 50 on the kind of the low end, I think you're pretty safe.
Very safe. Yep. All right, we got a couple more questions here. Matt, maybe this is for you. What do you think will be the exit cap? If I calculated it, it well seemed to be 5%. Do you see it attractive after 5 years if you're buying it today for a better rate? What's your exit thoughts on this, Matt?
Sure. So we build our exit cap rate based on sale comps, and then we really value our broker relationships. That's part of our due diligence, is saying, hey, once we are able to achieve this net operating income, where would you see this property trading? And for reference, we're coming in based on a T12 of a 4.39% cap rate, and we've actually expanded almost 100 basis points in our forecast, right at 5.2%. Most banks will assume 10 basis points per year. So in this regard, we're being more conservative than a bank. I do feel that there's opportunity that we could be even better than that based on the location and the desire to be invested in hard assets during inflationary time periods.
Yeah, and one of the things I think to note too is this location is actually continuing to get better. It's not going the opposite way. There's more great things happening in this area. And so this is a really strong market. And when you look at cap rates and you look at a non-compressed environment, if we look at a non-compressed environment, the cap rate spread between A up to C is actually a pretty good spread. Right now it's very tight. But what's happened is the Class C has really, really compressed, and the Class A has compressed much less as far as the amount. So I think we all feel the same. This Class A's, they're not going to expand at the level that a Class C or even a Class B will expand. And so I think having that large, just looking at where the cap rates are at today, these properties in this location are selling between 4, maybe up to 4.5, but closer to that 4 and 4.25. And so I think we're being pretty conservative with it.
Great. Todd, do you know if a financial advisor is able to offer accreditation status? Can a wealth management firm provide that for you? Most wealth management firms have CPAs on site. I mean, that's usually part of their solution. Do you know if that would work?
I'm not 100%, but when you go into the portal and you begin the process, it'll take you through the accreditation process, and it provides you a list of everything that you can use in order to get that accreditation status approved. And it should, again, we're giving you everybody until May 12th. So if you start that process quickly, and by the way, if you are interested in this investment, I do feel it's going to fill out very quickly. So if you want to put your commitment in, and you start that process quickly, you should be able to get it done well ahead of time.
Yep. Another question: what type of IRA can we transfer from? I'd say we're indifferent to that. We will accept any investment. I think that's between you and your financial advisor and your tax advisor to decide if that is an appropriate fit. It's money that comes to us. We all treat it the same, so we don't have any filtering for that.
Yeah, Drew, I think the biggest key to that is understanding how quickly those funds can move, because we don't have a huge time frame. So if you're not already having those communications, you want to get on that immediately tomorrow and make sure they can hit the quick timeline that we have. If the custodian can't, and we like Madison Trust, we like Equity Trust, we like New Direction IRA, and there's several other good custodians out there. We don't have a relationship with any of them, right? We work with all of them, but if you do have that IRA that you want to use, you got to act fast if you don't have a self-directed already set up.
Yep. Good. Okay. Andrew's got a good question. Andrew, will this 75-25 split occur after the 7-pref return is hit? Yes. What kind of economic backdrop would cause you to hold for longer than 5 years? What kind of economic backdrop? Well, I think, the lens that we look at these investments from is we're constantly reviewing what is in the best interest of our investors. I think at 5 years, if we feel that this property continues to have great positive cash flow, if the financing that we have in place continues to look attractive for the long run, we have another 10 years at 4.55%. If we find it in which a scenario allows us to do a supplemental loan, meaning if we can increase the value of the property, we can start to we can bolt on additional supplemental loans and start returning member capital back to our investors. I think those are all scenarios in which we might consider holding on to the asset for longer. Lisa, does Endurus ever pursue 1031 exchanges upon sale, allowing investors to roll into the new investments or all distributions to the LP taxable events? We haven't. I think we certainly could do that. I think in our syndication industry, that is becoming more common, is that as you spin out of a deal, that old deal becomes a tick as a tenancy and common owner into the new asset. We could certainly offer that. I think one of the great things about the tax benefits is that even if you completely cashed out and then you reinvested those full proceeds into the next deal, it's very likely that the passive losses on the new deal will offset the gains from your old deal, right? So as long as it happens in the same calendar year. So I think we would work with our investors based on the timing of the transaction, based on the intentions, and maybe just sort of see. But absolutely, we would love to keep our investors' capital rolling from one deal to the next. That's certainly ideal.
Yeah, then definitely. And there's several things that have to kind of come together, just so you're aware. And so, obviously we have to find a replacement property. That's first and foremost. And so there's just a lot of things that we have to work through, but certainly, as Drew mentioned, we'd love to continue to cycle into the next deal. And we'd love to, of course, we, as well as you, don't want to pay more taxes than we have to. So certainly.
Yep. Oh, so Eric, thank you, Eric. If I had you in mind as answering this question. The broker dealers can, with FINRA or RIA, register with the SEC, can fill out an accreditation letter. Okay, so you can go to your financial advisor so long as they have that component.
Great.
Jenna, estimated tax depreciation from a $50,000 investment, it would be somewhere between 25 to 35. That'd be kind of the range. $25,000 to $35,000 of a passive K1 would show up as a passive loss on a $50,000 investment. So 25 to 35. Did I hear that first-time investors can invest $25,000 minimum? No. Nope, $50,000 is our minimum. We're going to do more, and we'd encourage people to do more. Yeah. Missed this one. What is the long run expense ratio that you're modeling? Matt, you probably have that. I think right off the top, I know we're modeling about $6,000 per unit per year of expenses. Matt, do you want to give some context to where that heads over our forecast?
Sure. We see that stabilizing right around 47%. And that's where we look broad brush. But it's important when you see opportunities to improve income through either rents going up or you're just collecting more of the rent that you should have always been getting. There are expense lines that don't flex with income, right? Just because we're collecting more income doesn't mean that our utility bill is going to go up. Doesn't mean that we are going to have a higher marketing budget necessarily. There are expenses that go up with occupancy, but we've already got a very highly occupied property there. And so we haven't, what's been great is we've matched this with a budget from Denton Floyd, who's got property data points all around the area to draw from. We see this stabilize and we look at things on an expense load. So what is your per unit per year expense to run that property? And we see that stabilizing right around $6,800 to $6,900 a door.
I got to tell you, as someone that's been investing in the Memphis market for a while, it was really fun to go to our insurance broker and say, hey, give us a quote, and have them come back with, like, you basically have a perfect crime score, right? It is super low, easy to insure. And so I think there's some risk that comes off the table by investing in this kind of a market. And even our risk adjusters have been able to give us some more multi-year forecasts as well. So we're pretty dialed in on the expense side, probably more than I've seen than any other deal that we've been able to put together.
Yeah, I mean, when you look at just the simple risk-adjusted return on this investment, it's a simple asset to operate. It's in a great location, like we've already mentioned many times, and there's very little renovation to it. So it's a stabilized asset with a little bit of management upside, very little renovation need, and it's an excellent condition in a great neighborhood. So when we look at the risk-adjusted return to this property, I mean, it's an amazing. That's an amazing profile, in my opinion, and I think in all of our opinions. That's maybe one of the most exciting parts about it is it's just this, and our loan is locked in, like Drew mentioned, for 10 years at 4.55%. Like in this environment, you never know, and we're locked in.
Todd, we had one more question I missed in the question and answer portion. With 96 doors, will there be an on-site full-time manager, or will manager split duties with another property?
Nope. It's just at that point where it makes sense to have full-time people on site.
Yep. Good. Eric, are annual distributions classified as return on capital or return of capital? It does not buy down the LP equity percentage over time. Correct. Right. It is a return, is not a return of capital. The passive losses. Oh, I said the annual distributions. The way we model it, the annual distributions are a return on capital, not a return of capital. Return of capital occurs at a refinance event where we refinance above our current debt, and then we'd return 100% of those proceeds to our investors. Return of capital happens at a sale as well, where 100% of the sale proceeds first go back to our investors. Yep. So all of the distributions, the 7% pref and any split above that is purely classified as a return of capital. I'm sorry, return on capital, not return of capital.
All right. Last, Drew, if you have any more questions, that's fine. But I want to just make sure everybody understands. If you have already access to the portal, you can go in. If you're ready to make a commitment, you can do that now. I will be sending out an email this evening. Give me a while. Okay. But we'll be sending out an email with that information to everybody. So you have that along with this presentation. So you can get into the portal, you can make a commitment. This is all of our contact information. If you have any questions, investor relations, I typically handle that, but of course, if you can't reach me or you really have a great relationship with one of these guys, you can certainly reach out to them as well. But my email, Todd@enduruscapital.com. Reach out to me for any investor related questions, If you want to learn more about us, if you're here and you don't have a big relationship with us, enduruscapital.com. And then again, you'll be getting an email. Everybody that's attending here today will be getting an email. Give me some time. This has to record, and we got to get it all processed and everything.
That's a wild game.
Yeah, tomorrow morning, plan on it. Maybe later this evening, but that'll be to you. So super excited about this. If you have questions, reach out. I will be expecting to be taking phone calls over these next several days, be taking emails over these next several days. I've got time blocked for it. So reach out if you have any questions.
Yep, absolutely. Great.
All right.
Stop
Go wild.
Go wild.
Go wild. Awesome. Well, thanks everybody. Appreciate it.